Module 2 deals with money laundering. No, this is not where you put your money through a washing machine. The purpose of the Financial Intelligence Center Act 38 of 2001 is to combat money laundering, tax evasion, and terrorist financing activities. It came into effect on the 1st of July 2003. Money laundering is a worldwide phenomenon and refers in general to any process that will or aims to hide, conceal, or disguise the nature, source, location, disposition, or movement of the proceeds of unlawful activities, or any interest which anyone has in such proceeds. FICA is a preemptive act. Let me clarify that. It attempts to combat money laundering and terrorist financing activities, or to prevent the commission of money laundering or terrorist financing offences by imposing specific duties on institutions that may or could be used for money laundering or terrorist financing purposes. The idea is the imposition of these duties will prevent money laundering in general and the commission of the special money laundering related crimes created by the Prevention of Organised Crime Act and our terrorism acts. These are POCA and POCDATARA, and we will be looking at those. What did FICA mean to us? Well, it meant that we became the first African country to become a fully fledged member of FATF. That's a Financial Action Task Force. South Africa was accepted as a member of the FATF in June 2003 after it was evaluated and found to have developed a comprehensive legal structure to combat money laundering activities. Money laundering can erode a country's economy by making interest and exchange rates more volatile, and this can cause high inflation. Globally speaking, a money laundering act is considered to be performed by any criminal or third party, such as a F&I, insurance intermediary, or bank employee, which has the effect of concealing or disguising the nature, source, location, disposition, or movement of the proceeds of unlawful activities. The act referred to here is not the act of the commission of the original offence, but the act or transaction which has the effect of concealing or disguising the nature of the proceeds of the unlawful offence. So, what does there have to be in order to have a money laundering offence? Well, it's three core elements: the act of money laundering, the presence or benefit of proceeds of crime, and knowledge of the fact that a money laundering transaction is happening or has taken place. It's very difficult to say how much money laundering costs the economy. Governments can only make rough estimates to the total value of their legitimate money circulating in any economy. In South Africa, the estimate is about 80 billion laundered annually. Money laundering is considered to be one of the biggest businesses in the world today. There are three stages of money laundering. The placement stage, which is the initial entry of the dirty money or the proceeds of crime into the financial system. The layering stage, which is very complex and often entails the international movement of the funds. And the integration stage, where the money is returned to the criminal from what seems to be legitimate sources. The placement of proceeds of crime can be done in a number of ways. For example, cash could be packed into a suitcase and smuggled to a country, or the launderer could use smurfs to defeat reporting threshold laws and avoid suspicion. Some other common methods include loan repayments, repayments of loans or credit cards with illegal proceeds, gambling, currency smuggling, or using a legitimate cash-focused business to commingle the dirty funds with the day's legitimate sales receipts. So what are our main reasons for adopting money laundering legislation? Well, first of all, we are an international member of FATF. That's a Financial Action Task Force, and they fight organized crime and terrorism worldwide. We want to assist the state in fighting crime in the country. Now, our initial legislation in South Africa to combat money laundering consisted of the Proceeds of Crime Act, or POCA, which came into existence in 1996. The Act became known as the Prevention of Organised Crime Act in 1998, Act 121 of 1998, but it's still known as POCA. Let's have a look at this legislation. Our first act, I think, has to be FICA. simply because this is the main focus of our course today. FICA gives us certain duties. The duty to identify a client requires an accountable institution is not allowed to establish a business transaction or conclude a single transaction with a client without having taken sufficient steps in establishing and verifying the client's identity, and if necessary, the identity and authority of the client's agent or principal. The duty to keep records, which requires that the accountable institution must keep records of the identity of a client, the identity of anyone acting on behalf of the client, the nature of the business relationship or transactions, details and accounts of the transaction, and any relevant documentation for at least 5 years, and that's 5 years from conclusion or termination of that transaction. The duty to inform the Financial Intelligence Center of any requested information or any suspicious activity, which includes reporting certain transactions to the FIC. Finally, the firm has a duty to formulate and implement internal rules within the firm upholding these regulations and obligations. And this means there's a duty to train employees and to appoint a responsible person to monitor compliance. Our next act is the Prevention of Organized Crime Act. And this was in 1998 that it came about. If you remember, POCA creates the money laundering offences. Now, the principal money laundering crimes created by POCA are offences relating to racketeering activities, offences relating to the proceeds of unlawful activities. This includes money laundering, assisting another person to benefit from the proceeds of unlawful activities, and acquiring, possessing, or using the proceeds of unlawful activities. This Act has fines of 100 million to 1 billion rand or to imprisonment for a period between 30 years to life. This could be in addition to the fines in terms of FICA. So you don't want to play around with these two acts. The Preventing and Combating of Corrupt Activities Act No. 12 of 2004 is known as PRECA, P-R-E-C-A, and it has a couple of sections which are very important to us. Section 22, for instance, the National Director of Public Prosecutions may, upon reasonable suspicion, institute investigations regarding property relating to corrupt activities. Section 34 gives us a duty to report corrupt transactions. An amount of over 100,000 rand or more has to be reported. And Section 35 gives the provisions of this Act extraterritorial jurisdiction. Our next Act is the Protection of Constitution and Democracy Against Terrorism Related Activities Act, or POCTA-TARA. This was Act 33 of 2004. And came into operation on the 20th of May 2005. The main objective is to combat terrorism. It introduced a new reporting obligation under FICA Section 28A and amended the suspicious or unusual transaction reporting duty. This means a person must report a transaction relating to any property connected with terrorist financing offences and any person whose name appears on any lists published under Section 25 of POCTA-TARA. This is often called the Sanctions Lists. It is important to understand that none of these acts enjoy precedence over one another. They are all aimed at combating money laundering, but in different ways and to different degrees. The proceeds of unlawful activities are not restricted to the initial proceeds of crime, but also extend to the converted form. The crime does not have to be committed in South Africa, and it does not matter where the crime is committed.